Hello, everyone. My name is Clément Gignac, Chief Economist with iAIM Financial Group, and welcome to this fifth edition already of our iAIM Weekly Fall Series. And guess what? I'm back to the gazebo because this is like a summer here, like Saint Joseph in the mid-November, so quite surprising. So I'm very excited for this new edition because we have a special guest. It's my colleague Jean-Pierre Chevalier. Jean-Pierre have more than 10 years experience in the investment and with IA since 2012. He managed funds with assets exceeding now $1.4 billion. He have his thematic fund that we talk that invest a lot with our diversified funds. So, Jean-Pierre, we have received Jean-Pierre as a guest this summer. So, very exciting because notice last week was election week. We have this best performance since 1932 for an election week because, 7% up on Wall Street during a week, it's already exceptional. But in the election week, it's something we have never seen since 1932. In addition, we have a vaccine. So a lot of things to talk about with Jean-Pierre. So Jean-Pierre, welcome aboard, and you have the floor.
All right. Thank you, Clément. Thanks for the invitation. Always a pleasure to be here with you talking about the market. So as you said, I mean, the month is still young, but I mean, there have been so much catalyst happening in the market in the last few weeks. So we're going to talk about those. So first of all, we're going to start slowly talking about performances year to date. After that, we touch a word on valuation. Then you allude to the election. We'll talk about it. What does it mean within the U.S. equity market? Of course, the vaccine, and we'll end up with a few stock stories. I know people like when I share my views on a few stocks where we have a high conviction. So already in November, so the year has been flying by, but at the same time, it seems like January, February was another life, another. So things have changed quite a while. So let's start with the equity market, EFI index, which is the big loser this year, followed by the Canadian TSX, both in negative territories. But the World Index MSCI is at the end of October was in positive territory, same as the emerging market. And that leads us to our Industrial Alliance Global True Conviction Fund, which I co-manage with our international team, Pierre Chapdelaine, Sevgi Ipek, and the Canadian portfolio manager, Marc Gagnon. Both did a great job selecting stocks in that portfolio and enabling us to outperform the World Index. And again, this year, the S&P 500 outperforming the other World Index. But big winner this year has been the bond universe with a 7% return. And the both US fund under my management. So first of all, the US equity, which I took over last year, 7% as of October 30th, more than 12% as of this morning. And the thematic innovation fund that you know very well by now, up 17.6%, now 23% up as of this morning. So both's been adding value versus other world index.
So congratulations. Before I cannot let you continue without congratulations. It's very impressive. I know you're too much modest to mention, but you're close to the first decile and comfortably first quartile, not only year to date, but over the last 3 years. So very well done, Jean-Pierre.
Thank you, Clément. Thank you very much. We're working very hard. So our work ethic, I think, is our competitive advantage here. So continue to do so. I think it's the recipe for success here. Let's continue with a quick word on valuation. So when we look at the US stock market, I would say it's high on an absolute basis, but attractive versus the bonds. What I mean by that, on the left-hand side chart, we can see that on an absolute basis, the multiple of the market is screening high. But of course, I mean, stocks are not alone as an asset class. I mean, money flows in between asset class all the time. And when you look compared to the bonds, so when you look at the S&P 500 dividend yield versus the 10-year Treasury yield in the US, it actually screens pretty positively when you look at the long-term picture here. So it's important to know that the market multiple for stocks is directly linked to the level of interest rate. And more than that, if I can bring some more precision on that, it's the percentage of change of the interest rate that matters. What I mean by that is that at very low interest rate, the impact on the market multiple could be quite significant. Because if it's the percentage of variation of the interest rate, the change is the same whether you the 10-year bond yield, theoretically, as an example, go from 10 to 5%, as it goes from 2 to 1%. So 50% decline in the bond yield. Both have the same impact on market equity multiple. So at very low interest rate, it's theoretically normal to see multiple expansion like that. And so the valuation is attractive versus bonds, but the earnings recently, even though we're in between worst pandemic in modern era, uh, earning results are strongly beating Wall Street estimates. So you know how it works. You get an army of Wall Street analysts following companies, speaking to management, go ahead with their earning per share forecasts. And in the last quarter actually, those forecasts were have been significantly underestimating earning by 19%. In Q2, it was 23%. So the highest surprise ever since we were recording those kind of statistics. And when you look a bit deeper, you realize that it's not on the revenue that companies are surprising. It's really in terms of profit margin. And one of the main reason actually is company have been able to adjust their cost structure. Uh, and I'm looking here at business travel. So, I mean, advisors knows better than us, I would say, but we know a bit. We're doing this remotely by now. Can't wait to go back on the road at some point. But I think companies have learned that most of the selling, most of the selling process can be done remotely, and we think that will stay. That will stay going forward, even though the vaccine's coming back. Companies have realized that it's a low-hanging fruits for them to grab, and those margin expansion will be much more durable than Wall Street thing by now.
So, sorry to interrupt you. No doubt that earnings surprise explain the optimism that we see on Wall Street, but quite frankly, I think that deserves some explanation. What happened on last week, which was I mentioned earlier, the 2,000 point on Wall Street, the best week in election week since 1922. Is it because people smoke illegal substance, or they have a rationale to explain this enthusiasm on Wall Street about the presidential election?
It's a good question, and obviously those earning results happen while we had that U.S. election that was, most followed event probably this year. So when you look at the U.S. election, um, people were expecting, Wall Street was expecting a Biden win. We know margin survey has been wrong again, but the outcome was quite expected in terms of Biden's victory. But why the market welcomed this news very good is because we have a situation of gridlock. By gridlock, I mean we'll probably have a Democrat president and a Republican Senate. Well, it's not a done deal to have a Republican Senate. There will be, right now, it's 50-48 in favor of Republican in the Senate. We will have 2 runoff election in Georgia in January, because in that the candidate need to have 50% or more of the vote to be elected. So Democrat will need to win both to have a Democrat Senate, which is still highly unlikely. I mean, it's not, as I said, it's not out question, but to our view, it's still a very low possibility. So having said that, when you have a gridlock situation, it's very tough for the president in place to push their regulatory change, to push their agenda. In that case, Biden had an agenda which would have been perceived negatively. Some of it would have been perceived negatively by the market. And by that, I'm talking about his plan to raise corporate tax, to raise also to make some significant change in the healthcare sector, some reform there, to go ahead with a massive stimulus plan, $2 trillion. I think it's going to be much less than that, and to go ahead with some significant uh,
Gain of the gain on capital gain taxation. It's a relief, you will say.
Yeah, gain of capital, of course, I forget that. So of course it's a relief, and also on the big tech company, he was aiming to go ahead with more stringent regulation, which will be tough. So he will have to make choice in between all of that, and we think it's highly unlikely that the full scale of his plan will be passed at this point. And when you look historically in this chart in the last 30 years, whenever you have a gridlock situation, U.S. stock market is a good place to be.
Interesting.
Yeah.
And this week we have this vaccine as well as a big news, game changer.
Vaccine,
breaking news. Yeah, go ahead.
Vaccine, a big news. Just before going there, when it comes to the election, let's dig just a little bit deeper into what it means for the stock market, what it means for the healthcare. We think there's big opportunities in the healthcare in the short and the long term. Big news for humanity, that vaccine announcement. And when you look at the healthcare sector in the short term, when you look at the discount in terms of valuation versus the S&P 500, it's at a historical level. And the reason is simple. There was fear, actually, that Biden might be able to push his agenda, to push his healthcare reform. And we kind of saw this playbook in 2016. So healthcare outperformed following the election. Same in 2012 in the Affordable Care Act. Healthcare was able to outperform following that. So it's usually a good playbook to go overweight healthcare following the election. And those that saw me present in the past knows that over the mid to long term, many futurologists think that we're entering the biotechnology era. Right now, I mean, genomic revolution is starting to have significant impact in clinical trials. Very positive in the impact of robotics in healthcare equipment. We think connectivity adoption and telemedicine has so much low-hanging fruit to grab still. And the application of artificial intelligence to lower costs in healthcare is also something that will help this sector a lot. So we have an alignment here of the short and long-term factor that makes us very positive in that sector. And as you said, Clément, we cannot go silent over that big news earlier this week of a highly efficient vaccine coming.
Yeah, that need explanation because not the first time we talk about vaccine. In the previous times, Moderna or the others, when we have this positive result, we see positive reaction. But this Monday it was difficult to believe when you see Zoom decline by 16%, banks up 16%. What is characteristic about this special announcement? Is it this 90% effective? Could you explain to us?
That's it. You pinpointed 90% efficacy is much higher than what people were expecting. Actually, most specialists said that over 60%, it would be very, very positive news. So 90% efficacy, a great day for science and humanity. What we have to understand is there have been surveys in the last few months about the uptake of the vaccine. How many people would be willing to take the vaccine? And we haven't seen result much higher than 60%. We can debate a whole lot about why people, about the reasons, but the fact that at 60%, you need a highly efficient vaccine to get to what we call herd immunity, to get to the point where transmission is getting very, very low because people have immunity. So at 90%, herd immunity, according to specialists, is around 60%. So if you can give the vaccine to around 70% of people, we get herd immunity. But more importantly, with a highly efficient vaccine, the most important thing is to get the R0 below 1. The R0 is the number of people that get COVID from people that already have COVID. So as long as it's over 1, the pandemic would continue, the case will rise exponentially. As it gets below 1, the pandemic will die by itself. So even if we're able to give vaccine to 40 or 50% only, that's still a win. It will take maybe a little more time than if we give it to 70% people. But as long as we get over that 30, 35% level, the pandemic will die at some point. So it's very
Okay.
positive.
Yeah, it's very well explained because this is the first time I really understand why it's so important because you make the link with the vaccine take-up rate. So to deal with the pandemic, it's very important that it's much more effective because it's not everybody who accept to take the vaccine. That's what I understand from your chart.
Exactly, exactly. And Pfizer is the first one also, and we got that big bang of an announcement of a surprise, and keep in mind that others will report also in the next few weeks, next few months. At the end of the month, we have Moderna. Then till the end of the year, we'll have AstraZeneca, and early next year, Johnson and Johnson and Novavax. So there's more than one shot on goal here
Uh,
to get over this pandemic.
we forgot to mention that Russia mentioned this morning. By the way, it's 92% in our case. So the Sputnik vaccine, Russia, but we take that with a grain of salt. I'm just kidding you.
Yeah, no, of course. What happened in China and Russia? We don't have visibility on actually the data, so we
Yeah,
have to take
I
that
let
with.
you. I let you continue. Sorry about that.
Um, so that's very, very positive, all what I said, but I mean, there's risk factor to monitor going forward. Obviously, there's always risk factor, I would say. But right now, just talk about COVID, the vaccine, but that second wave, I mean, the news we're having in the last few weeks has been just very bad. I mean, in the US, number of hospitalization, number of death is accelerating as we speaking. So it's too bad to say that we might have a dark winter before the vaccine is distributed on a large scale, which will be spring, mid 2021. So let's keep in mind that, I mean, of course, the market is anticipating things, but depending of the importance, the magnitude of that second wave, it could get bumpy in the next few months. Other risk factor, the U.S. political transition, lots of noise right now, but when you look at the big picture, things is going relatively very well in terms of social tension, that kind of thing. So let's just say something that we have to monitor going forward. And last risk factor is the inflation making a comeback. Because I mean, all those technological advancement in the last few years really, and COVID particularly, really accelerate the growth of what I call the intangible and the disinflationist pressure. An example right now that work from home, we're starting to see people emigrate from big cities to suburb and rural area. Pressure on big cities rent is starting to be felt much more than elsewhere. So again, it's you always have to look at the second, third order derivatives of those technology, what it means in the big scale of things. So whenever we have that vaccine and we might have a consumption boom since people will be willing to spend, and that also with the fact that supply chain might still feel the impact of COVID. There might be some inflation there, but it will be a tug of war between those disinflationary pressure. But it's much more a second half 2021 debate for me. So let's keep that in mind for now.
Okay. So time is running. We have probably maybe a 10-minute left. Maybe spend a few minutes on your fund to explain more the way you have allocated by sectors and your style as well to explain your alpha maybe.
Sure. So thematic innovation fund. I remember always people, it's a well diversified strategy. So the main highlight, we have around 90 position, strong focus on risk management, and position sizing is also very important for us. That enables us to don't let emotion take places. So in terms of position sizing, whenever we have a high risk, high reward proposition, it might not make our way to the top 10 in terms of weighting, but it will make its way in terms of top 10 in terms of alpha contribution. So we're really more betting on our batting average, to make a baseball analogy here, than on to hit home run all the time. But don't get me wrong. I mean, we still hit home run. Actually, this year we have 6 stocks that have double or more in the portfolio. Of those 6 stocks, 3 is in the healthcare sector, 2 in the consumer discretionary space, and 1 in technology. And actually, I wanted to show you this, that stock selection explains most of the added value. We quite often show the allocation chart, what's the percentage of weighting by sectors. But most importantly is the performance of stock in each sectors versus the one of the S&P 500. That's what really matter. Much more than the allocation when you look at the added value versus traditional S&P 500 index. As an example here, that sleepy sector of utilities that we don't get much years in, years out. This year, we've been able to have significant performance by bidding on renewable. Okay. Also, lot of people, a lot of ink on the outperformance of technology. But when we look at our fund, our best sector is actually consumer discretionary. Then it's utilities, then it's technology. So again, we have to always take with a grain of salt the allocation, because stock selection is what matter in our case.
And maybe you have some example before going to Q&A and I remind people if they have any question to Jean-Pierre, feel free to use the chat box. So precise name you can talk about?
Sure. So I talk about those 6 stocks that have done very well this year. So let's give a few examples of those 2020 winners as of the end of last month. First of all, let's talk about NVIDIA in the artificial intelligence theme. So NVIDIA, it's the ultimate AI company. So without NVIDIA, there's no AI, as simple as that. NVIDIA CEO is a well forward-looking, one of most impressive forward-looking top management that I've heard in the last few years. AI, it's a little bit like internet was before the arrival of search engine. What I mean by that, early 90s, always people, it was just people with some technical capabilities that were able to go on the internet. Well, same for AI right now. But this year, with the arrival of what we call GPT-3, a generalized pre-trained model that's really giving the tool to people to build AI application without big technical capabilities. So long story short, I mean, we quite often say that mobile, smartphone, that gives us access to all the knowledge in the world. Well, I think with the arrival of GPT-3, that actually gives us about 10,000 PhD to discuss with anytime in our pocket. So it was a news that went a little bit, that I think was very, very underestimated by mainstream media. But don't get it wrong, I think it's something that will be very, very important in the next few years. We sold a bit of our position in NVIDIA following strong performance. We're still a shareholder of the company. We still think the street is underestimating the total addressable market of artificial intelligence in the next few years. And we would more than welcome a pullback in the stock to add to this existing position. Let's continue with Tesla. Tesla's been a big winner in the transport revolution themes. So I've been, arguing for years. People were asking me, why don't you own any Tesla? It's because there was some execution problem. Remember a few years back, this company was over-promising, under-delivering. And really what made me change my mind is what they accomplished with their Chinese factory. The ramp-up of that factory was just spectacular. really straight out, flawless execution on that front. And also at some point this year, Mr. Musk started to give hint on what would be the ultimate business model of Tesla. So then people start speculating, oh, there's innovation in terms of electric vehicle, in terms of connectivity, but there might also be innovation in terms of the business model in itself. What Mr. Musk said, basically, it's at some point, he's intending to sell the cars at cost and sell a subscription plan, yearly subscription plan to get your software update, to get your autonomous car, autonomous driving module, to get all those software add-on. So that's really highlight the potential here of the model along with execution. Having said that,
waiting
yes,
to Microsoft and the other software company that you have to have an update and new pre-feeds for that. It's interesting. But
exactly. The market really like growth visibility, and company gets that, and that's why like company like Walmart are coming ahead with their Walmart Plus, a subscription plan, but because it's giving visibility, growth visibility to the street. To come back to Tesla, having said that, stock's done very well. So we bought it at the bottom and we sold it right the day when they pretty much split their stocks. And that day the stock did very, very well. So we don't own any Tesla right now, but we still monitor that position pretty closely, and might re-enter a position at some point in the future. Lastly, another position that did well for us, iRhythm Technology, in the personalized medicine theme. So iRhythm, it's a provider of a heartbeat halter, heartbeat monitor. So whenever somebody do have problem like arrhythmia, he goes to the doctor, he gives him iRhythm halter in order to monitor his heartbeat for a few weeks. Well, what really made a difference for iRhythm this year is they have the only provider of bi-directional communication devices. So in a post-COVID world, that was really a significant competitive advantage because the doctor was able to monitor his patient remotely. Okay, so it's not able to do that with the other competitive device out there. At the same time, iRhythm is running clinical trials to prove that they could help what we call asymptomatic patient. Asymptomatic is people that don't feel problem with their heart, but that might have a health profile, meaning that they're high risk to suffer an infarctus, to suffer heart problem in the future. So they're running clinical trial to prove that they can foresee any potential heart problem. So partnering with insurance company to give the device to high-risk people in order to save to the healthcare system major dollar in terms of surgery and any complication that might happen with those people. So we're expecting news on those clinical trial in the next few months, and they're also developing their next generation of device with Verily, which is a Google subsidiary. So the end game for them might be to get bought out, but we'll see. But long story short, we're very positive. We haven't sold a single share of iRhythm Technology.
I thank you. So I think Clément's having a few problems, so I might be taking over here for him. So sorry about that. So we do have a few questions. The usual suspects first. So let's get these out of the way. As you've mentioned, we've had quite a strong rotation between value and growth and the performance of the NASDAQ versus the Dow Jones in the last few days. So can you just give your views or your comments on if these are important and what are the ramifications, let's say, for the next 2 months?
Yeah, good point, Sebastien. Well, that Monday rally following the announce of a vaccine was actually a more than 10 sigma events. So what it means, 10 sigma, it never happens. Okay, it just never happened usually. So why the street was surprised by that, why the market was surprised, is the efficacy rate that we talked about earlier. So that's the sixth attempt of a cyclical rally this year. Usually out of a recession, value or cyclicals always outperform. That wasn't the case this time because of the nature of structural change and the nature of the pandemic too. So in the short term, we think it makes sense. We think the stocks had a lot of stocks at strong reaction, and it makes sense in the short term. Over the mid to long term, in my view, you really need a reflation catalyst to change a bit the picture of the economy. It would be surprising that this comes from the private sector, because if it's one thing, COVID-19 actually accelerated permanently the growth of intangible and the disinflationary pressure. I gave the example of real estate earlier. And also, there's still uncertainty on the long-term business model of many of those cyclical sector, like traditional oil and gas, like banks, like all those companies over the long term still have question mark. The real catalyst that would change my mind, in part, would be we talked earlier about those gridlock. So if the Democrats can get those 2 seats in January, that would mean a blue wave. That would mean significant fiscal stimulus. That could bring that reflationary momentum on the fiscal side. But right now, our strategy is really to go barbell, to go with those long-term structural winners, and on the other side, to tilt the portfolio a little bit more towards those recovery stock. Like we had a position in the airliners. We've never been shy of holding banks in the short term because we think they're undervalued. So we'll go barbell in the next 12 months. We think is the right strategy.
So I'm back, Jean-Pierre. So thank you for
Glad to see
Sébastien.
that.
We have always a backup plan. We never know. So
Teamwork.
particularly when I do that live from my gazebo. Okay, so I understood that the question was on sector rotation. Answer your
Yes.
question. I have another question I received. It's regarding the renewable energy, because we have noticed when you go with sector allocation that energy is zero. But I think you have mentioned to me recently that you have exposure to some renewable energy. So could you explain that situation?
Sure. Well, Sébastien, if you could bring us back to that allocation chart. In the meantime, I'll explain that renewable, smart energy, it's one of the big four innovation family of themes we have identified. The other three are connectivity, robotics, and genomics. So renewable is very important for us. We think the driver are technological. We have visibility on the decline in cost structure there. And to answer your question, when we look at the energy sector as defined as in this chart, it's really oil and gas and natural gas and pipeline. So there's no renewable in there. All the renewable stuff is within utilities, and some is also in the industrial sector. So also that explains why in the next chart we were able to outperform significantly in the utility sector, because we always put extra emphasis to all the winners, but also avoid the losers. All the winners, companies strongly aligned, strongly exposed to renewable electricity energy, and losers avoid traditional utilities exposed to coal or natural gas that are having a tough time right now, really get higher valuation by the market.
Okay, interesting. So maybe one last question, because we already exceed our time. So before conclude, so do you invest in the Bitcoin? This is a question from Joe, and I will go more broadly. In fact, could you talk about payment system, because people who have a significant shift the way that we can pay now, and any particular stock that you have in your fund that have a leverage regarding this new trend?
Yeah, great question. So Bitcoin, I mean, the last few years against all has been able to do okay, I guess. I guess this year, but obviously I manage U.S. equity funds, so like I don't invest in gold, like I don't invest in bonds, I don't invest also in Bitcoin, so I only invest in U.S. equities. When it comes to companies' exposition, it's very tough to see exposition directly to Bitcoin. Talk about Nvidia. There's a small part of their business exposed to Bitcoin mining. You need GPU for Bitcoin mining, but it's really not what is driving the stocks. So It's mostly stock exposed to that is in the micro cap world, which we're not playing. But like you said, Clément, financial technology, evolution of payment system, it's really something that is happening, that's been happening in the last few years, that is happening right now, and that will continue to happen in the future. One stocks we have in portfolio to take advantage of that is PayPal. Actually, PayPal, another company called Square, are really growing strongly what we call the virtual wallet. So for PayPal, it's a peer-to-peer virtual wallet called Venmo. So what is important to understand is that those virtual wallets are stealing market share from traditional checking accounts at the big banks. Like Square with their Cash App has been able to grow more than 170% in the last quarter. About 30 million people are using that virtual wallet share. So it's really negative for it's mostly regional bank. I think the big banks will do well, but the smaller banks in that environment are losing market share. And those payment technology will continue. I think more and more we're talking about adding an artificial intelligence overlay that is able to connect in all your money, all the money you have, and able to allocate efficiently all your money, and able to avoid any checks that might not be funded, in order to avoid have money sleeping in your checking account. So also don't underestimate that profit pool that is under attack there by financial technology company.
Interesting. So that sounds that we will see a public consolidation in the banking sector in US. People in Canada is not aware, but before the financial crisis in 2007, we have close to 10,000 US banks. Now it's probably around 3,000. And when I hear what you just explained, I think that we'll see probably consolidation down the road. Time is running so fast that Jean-Pierre, we have to close now this webinar. I'm so happy that my decision in early October to book you the week after the election, because guess what? We have your explanation to explain what's going on, this gridlock situation, and lucky enough to have the announcement of the vaccine. So we benefit of your expertise on that. So I want to thank you a lot, Jean-Pierre. Congratulations again for your performance.
All right. Thank you very much, Clément. Thanks again for the invitation.
I want to thank, before conclude, Sébastien, who has been as a backstop. We have done that all the summer long, all the winter. Paul, and December is the first time that I arrived, but it's good to have always a B plan. Thank you, Sébastien, for that. And this is our next edition, Wednesday, 11 o'clock. We will have Jean-Pierre Dagneau. Jean-Pierre is our portfolio manager on the corporate bonds. So it will be very interesting, possibly with this narrowing spread. We still have some fuel left in the tank with the spread so narrow. So it would be interesting. So on that note, I wish you a good day and a very nice week.